Hey, what's happening, guys? Hope you are doing well. Hey, I get asked quite often, what does it look like and how do you do the research for an investment property, especially if it's going to be something that's not in your backyard? Maybe it's out of state, it's a market that you're not familiar with. How do you research it? So today I want to walk you through a little bit of a demo. I'm going to use a market that I'm somewhat familiar with, but I'm going to show you how I got familiar with it in the first place, how to identify some deals, what they might price like, what the cash flow might be like, and what the potential return on investment might actually be. So let me share a screen with you and let's take a deep dive into this market. So we're going to look at properties here in Montgomery, Alabama for right now. We're going to look at these as rental properties. And so I'm going to use some tools that you would all have access to, and one that you have to reach out to a professional like us to receive access to. It's free, but we'll show you how to use all these things. Okay, so first and foremost, let's just use Zillow as an example. So for right now, I just set up a quick search. So I did Montgomery, Alabama. I kind of framed in the area that I want to focus on. Got 3-bedroom, 2-bath. I've got a single family home. I have a filter here for anything that's after 1980. I didn't want to see anything below that particular date. And these are the results right here. So you can tell on rents, you've got about 36 different results. You can scroll through them. You can, check high to low or low to high, whatever you want to do. All right. Then I'm going to do the same exact criteria. I'm just going to use it for a purchase. So here's all the homes on the market. So you can tell rental market's got 36, but man, we got a lot of properties here listed for sales. It's kind of a hot market right now. A lot of properties coming on the market, probably a little bit of a surge in market activity. And what we want to do is we want to try to start looking over what we can see here and find some commonality. Now we'll look over here, we can see different price points for rent. Like in this case, I already kind of mapped out this one, so I'm going to focus on this. So you've got really the streets here, Taylor and Vaughn, kind of over by Bell Road. This is $1,400 a month, 3-bedroom, 2-bath, 1,177 square feet. Let's take a look on the purchase side. Well, guess what? We've got one right in here that's really, really similar. So we're going to pull this one up. This is for purchase. This happens to be under contract, but we're going to use it as a quick example. So 3-bedroom, 2-bath, 1,300 square feet. And this one is a 3-bedroom, 2-bath, 1,100 square feet. So we'll pull these up side by side so you can kind of get a feel for what they are. You can tell these are both, kind of the cottage house. Let's try it. There's one more right here. Hold on a minute. There's another one here at 1,400. I think is a better, this one. Okay, cool. So this is the one I want to use. This one's a little bit closer to the property here on Water Oak. So Water Oak is 3+2. 1,300 square feet. This is a 3+2, 1,374 square feet. It's almost the same, similar area. You can tell even from the front aesthetic that they're very, very similar, right? You got your little window here. You got your brick kind of outlay. These are garden homes right here. And so they a lot of times don't have a garage. They'll have an alleyway for access in the back, real common for the area. And you can see this one's listed at $1,400 per month. Kind of flip through here, get a feel for the condition of the home. And then what you're going to do is you're going to look at the one. Now, let's say this one was not under contract. This was just a home that you were considering buying maybe as an investment property. Same thing. You can look through here, get a feel for the condition, and now you can start to compare. What I do is I'll try to do this multiple times. So I'll look at properties in various markets, start to kind of create some commonality with them. I'll follow them. I want to see how quick this goes under contract, what it actually sells for, and I'll follow the rental and see how long it's on the market before somebody snatches it up and decides to rent it. And so what we're going to do is we'll look at this particular one, knowing that you could probably buy it for around 150, and you could probably rent it for about 1,400. We'll make some assumptions around there, and let's build out a pro forma. So if we use this as a pro forma right here, you'll see the rental income is at 1,288. So what I did is I assume that you're going to use a property manager, and you're going to pay probably an 8% fee for that property manager. So you got $1,400 a month and multiply it by 92%, gives you 1,288. That's the income that we're going to use. So it's net. You're not having to factor in. We've already kind of done the math on that for what the property manager would cost. So 1,288 net to you if you got 1,400 a month in rent. Expenses 1,088. What I'm using on this one is I'm assuming a 20% down payment. I'm assuming a rate at about 7.75%. Hopefully the rates are lower at the time, but let's just use that for right now. 30-year fixed. I kind of built out property taxes and insurance according to what to expect for the market and what the tax rate is. And that gives us about 1,088. Also built into that, if you kind of scroll down, kind of blow this up a little bit for you. Right in here, I built out maintenance and repairs. And so 960, per annual divided by 12, $80 per month. I built that out, and it doesn't mean you're going to spend $80 per month on repairs and maintenance and that sort of thing. But at some point during your ownership, you're going to have a cost. You're going to have something that goes out, needs to be fixed, needs to be repaired, etc. And so we want to budget for that so that we're not trying to figure that out on the fly. I want to account for that down the road. So if that repair comes in 3 years later, well, we've stacked up 960 per year over time. We're ready for that repair. We don't have to stress too much about that cost. So we're accounting for that in our overall cash on cash return. Because again, year one, maybe you don't have any costs. Year two, you don't have any. Year three, but year four, you do. Okay. So maybe that cost is $3-4 grand. Well, you save money for the first 3 years. Now you have it in the fourth year. We want to make sure that's part of our cash on cash return. So when we kind of look this over, it doesn't look too hot when we do the initial number. Like on this one, $200 a month in cash flow, it's not going to change your life. You're going to have a lot of money going out the door to buy this home, and to get $200 back isn't great. But what we want to do is we want to look at it over time. Time in the market really heals all wounds. And we know that we're coming in at kind of a higher price point, coming in at higher interest rates. But I want to show you that there's still opportunity within the marketplace if you're in the market long enough. So in a 10-year window, your cumulative cash on cash return is 109%. It's a pretty good return. One thing that you're going to notice is I considered a 3% annual increase in rent over time. So you can see how the rent starts to stack up later. You'll notice that we're not factoring in a potential refi. We're not making assumptions that rates are going to be cheaper in the future. We're just saying, hey, if this is the rate we get from day one and we're stuck with it, what does it look like? And you'll see that principal and interest remains exactly the same all the way across the board. Of course, if there's a chance to refinance, it's going to better your position. It's going to improve your cash on cash return. But for right now, we're just going to assume that that's the best you get. Property taxes and insurance are all built in here, and you'll see that those start to increase just a little over time because they're naturally going to progress upward. And then our maintenance and repairs kind of factored in, but again, at a consistent factor all the way through. Property management fee, I left that off. Again, I kind of already accounted for that right up here. So in this property, you would rent for about 14, you would net about 1288 and back out your expenses from there. So let's take a look at what things potentially would be if you were to exit this home in 10 years. We have to take a forecasted appreciation rate. Forecast for that particular area is 4.65% year over year. And so this property's estimated value in the future is somewhere right around 236K. You can see there's the interest rate that I plugged in for right now. You can see the annual rent increase I'm using is 3%, pretty conservative. Some markets have been significantly higher. In fact, they've been like double digit recently, but we're going to use a very consistent factor for rental increase over time. And you'll see that at the end of 10 years, you'll have a loan balance of about 104. So now you owe 236, you got a balance of 104. Your original loan was there at 120. And what we're going to do is we're going to just look at the overall rate of return. So you've got your rental income that's come in over the whole 10 years. You've got the appreciation that you gained for owning that home. So this is your gross revenue. Back out all your expenses, your property taxes, your insurance, your closing costs, etc. You're left with somewhere right around 121,000 in profit. You'll notice down here, sell and fees. So I built in the potential cost to sell the home in the future. The real estate agent cost to sell it down the road is kind of built into this overall 142 strategy for expenses during that 10-year window. And so if you kind of look this over using your down payment, not using closing costs, et cetera, that's all built into this. So just the down payment was 30K. Closing costs were all built into the 142. So off of your $30,000, you're making about 121. You're gonna walk away with about a 404% return on investment. Now it's after a 10-year window. What if you held the home for 20 years? What if you held it for 30, 40, 50 years? What if part of your plan is to keep these homes, allow them to kind of feed you as part of your retirement plan in the future, and then pass them on generationally to your kids, to other family members, et cetera, through estate planning? So what would rents be in 30 years, 40 years, 50 years? You have to kind of look out long-term on these things and realize that that's where the big money is in real estate. It's not going to be what I bought it for today and what I can turn it for, next year, the year after that. That's got some volatility in there, some uncertainty in there. You got to look a little further out. So I want you to kind of play around with that idea right there. But you can see you've got a really nice, your average annual compounded return is 17%. It's really a solid return on investment. And if you start to stack these up over time, you had your $30,000, let's say you had another 10 to get into the property, and over a 10-year window, it's a really good return on your money. And look, at the end of 30 years, if the house is paid off, your cash flow continues to kind of stack. You see the numbers right here, where your initial cash flow for the year is only $2,300, but by year 10, making $6,900 a year. But year 30, all of that goes away, right? So that makes a massive difference in the future. So I want you guys to, again, consider things long-term. I hope this kind of helped you a little bit. I want to show you one other tool that I use to kind of get a feel for how to enter the market. So in this example, I'm using the zip code of 36117. There's a platform that we use with our buyers called HomeBot. And what it does is allows us to plug in a market. In this case, I plugged in 150,000, and I looked at the zip code here, again, 36117, and I'm getting a kind of a temperature of the market. You can see it shows an 82. What does that mean? Let me kind of back out for a second and show you. So this is the market we're looking in right here. These are surrounding markets, and there's a scale that we use. So 100 would be like a full-blown seller's market. The buyer really doesn't have any say. They're going to get the only way they're going to get their offer accepted is no contingencies, bid over the asking price, multiple offer situation. That would be more on the 100 side. 80 is still favoring the seller. Something that would be maybe in the 50s, 60s would be a little bit more of a balanced market. And then obviously if you found a property or an area that might be in the 30, 40, that's more of a buyer's market where there's plenty of homes on the market. The buyers have a lot of say. So this particular area of Montgomery happens to be a little bit of the nicer area to live in. It still has a lot of activity, but if I was to scroll outward, you'll notice that there's some outskirt areas. So Matthews, Fitzpatrick, these are cooler markets. So you have a lot more room to go in and make maybe some more aggressive offers on homes like that because there's too many homes in the market versus the amount of buyers. Buyers are scarce in these parts. This may not be the best place to live. I don't know that. We'd have to do a little bit of research on it. But this tool gives our clients access to quick data points. You've got right here, you have Millbrook is 97. It's a really hot seller's market. And right next to it, 30. Well, it's probably 30 for a reason, but let's find out. Let's do a little bit of research and let's see what we can come up with on that. So a tool like that's really helpful. Hopefully you guys you can find this stuff useful. Let me know if there's anything that we can do along the way to really help you kind of prep for home ownership and to maybe consider investing as part of your real estate strategy and your long-term wealth strategy. All right, guys, I hope you have a good one, and we'll talk to you soon.